ready to go, but we had some technical difficulties and had to shift gears. But we're here now and ready to go. I'm Steve Morris at OTBC, here with Ernie Boetsma from Ader Wynn, and you can't see him, but off to my right is Jim McCrite, who is monitoring the chat room to keep us on track with questions. And of course, the topic today is talking about the SAFE, the Simple Agreement for Future Equity, both the pre-money version, the original one, and the post-money version. Quick background, this is coming to you from OTBC, and we're a startup incubator in Beaverton, Oregon. The thing that we have coming up that you'll hear about soon is we'll be opening our Startup Challenge for applications here by the end of the month for startups to apply for a $25,000 investment and residing here at OTBC for a year. Ernie, want to do a quick introduction of yourself?
Yes, good afternoon, everyone. I'm Ernie Boetsma. I'm a partner with Ader Wynn Law Firm, and we're a law firm that specializes in working with businesses, and specifically I've been working with entrepreneurs and startups for more than 20 years.
All right, so let's start. Maybe I'll start out with a couple of questions for you, Ernie. In two different videos, we obviously covered both the original SAFE, the pre-money, based on the pre-money valuation, and then the later SAFE, modified last year to do post-money to address a number of issues. Here in the Portland market, I think if I remember last time, you see more convertible notes than SAFEs. But in the SAFEs, have you actually seen any of the post-money SAFEs yet? Or has it all been pre-money so far?
That's actually a great question. I've mostly seen the pre-money valuation, and I think that's partly just timing. So in other words, I think generally more people are using convertible notes in the Portland area for a number of reasons, which I think you identified in the videos about sort of the time frame and the lack of interest rate and so forth. So we don't have a lot of investors who are excited about SAFEs, but the ones I have seen are the older version, partly because they were companies that have really got into doing this probably 2-3 years ago that I saw more of them.
Mm-hmm. So when that's the only one there was.
That's right.
By the way, I want to encourage everybody, please go ahead and post your questions on the SAFE or the SAFEs versus convertible notes, and we'll certainly try to field those as they come in. So from the actions or activity you have seen with SAFEs here in the Portland market, any particular things that come to mind that have been the challenges in getting those negotiated and in place?
Well, I think the goal with SAFEs is that you really want to download them and not have any negotiating whatsoever. I mean, that's one of the attractive features of a SAFE.
Yep.
And I think a number of the companies I've seen or worked with that have used them, they have been successful in doing that. So in other words, their investors were well acquainted with the instrument, and so were already prepared to negotiate and purchase a SAFE just as it was downloaded. Mm-hmm. I think anytime you start getting into negotiating over those terms, you're right back in the situation where maybe a convertible promissory note might have been just as at least cost efficient from a legal standpoint. Mm-hmm. In terms of the negotiating of the terms, because the terms are most of the terms that were identified in the video, for example, the valuation cap, I mean, they're pretty straightforward negotiations. So in other words, they're a dollar amount, and so it's really just filling in blanks. So most of the negotiations usually go fairly quickly.
That would be the goal. I'm curious, can you remember if some of the SAFEs that you've have done, did they stick pretty much to the existing documents, or did you see this tendency to add additional terms, additional rights or constraints, anything to it?
I have to say most of the rounds that I've done that were SAFE rounds stuck strictly to the terms, because again, I think maybe at one point hit upon is safes are very company friendly. I mean, that's one of the reasons why investors, at least push back on them enough, because, without the interest rate and without a maturity date, without a trigger amount for the conversion into the, the hypothetical Series A, I mean, they're very company favorable. So again, from when clients come to me, the company's driving the initial terms, and so they like to pull it directly from the website and use those terms without much negotiation. Now, if there is a pushback, it's going to be investor driven. It's going to be the investors being sophisticated enough to understand what terms are in there, maybe add some of their own specific terms. So, for example, I have actually seen where an investor has asked for not necessarily a maturity date, but a required conversion date, which was essentially the same thing.
Pretty close.
And so, again, tried to address that particular issue by just amending the document. I think you do point out in the video that the website does indicate that these are supposed to be used without any change. They are copyrighted documents, so technically altering them does probably breach the copyright of Y Combinator to do so, although I've never seen anyone really complain about that particular issue.
Yeah, they don't seem to be going after people for
No.
copyright violation.
No.
Let's see, we do have one question. This is actually more on the accounting side. Where on the balance sheet do you record the cash from the safe?
So I think, and I'm not an accountant, so I don't know if I truly can answer that. My belief is that you take that in and treat it the same as you do as stock. So in other words, this is not debt. And even in the instrument itself, one of the provisions in the back describes it as treating the safe as common stock for all tax purposes. So if I were to view it just based upon that particular term without being, again, an accountant and knowing a balance sheet in and out, I would think that you take the cash in as though it were an investment in equity. You don't yet have a specific number of shares, but you treat it as though you're taking it in as an equity investment.
Yeah, I know the statement is in there for tax purposes, right? Mm-hmm. To guard that. I think I know in the case of convertible notes, I'm pretty sure they actually show up as a debt on the balance sheet.
Yeah, and I think that's one of the reasons why you might argue this is slightly different, partly because it's not structured as a debt.
But then again, safe isn't a debt, so yeah. It's something different, but we would have to, I think, both agree that the safe person to ask that to would be a CPA.
Yes.
But that is the interesting question. It's not a convertible note. It's not debt, and so being not debt, it probably doesn't show up as a debt on the balance sheet. It would look more like
shareholder equity. So that yes.
Let's see. Kevin says it's stock equity and doesn't count as an OP. Yeah, because it makes sense because it's not.
Yep.
It is not. That's the whole point. It's not debt. It doesn't have a maturity date or an interest rate.
Yeah, and I think again the way I look at it is if equity's on one end of the spectrum and notes are on the other end, then certainly safes are going to be somewhere in the middle, closer to the equity side. So that's how I would treat it.
Yep. So so thanks, Matthew, for that question. And again, if you have other questions out there, please go ahead and get them posted. We need to take advantage of Ernie being here and see if we can learn a little more on the legal angles of all of this. Let's see. Trying to think what other things I was going to ask about in terms of what was in the video.
Well, actually, something that wasn't touched on in the video, and I think you and I have talked about before, and I've had this discussion with clients, and one of the issues with safes is they come across, at least to the entrepreneur, as being a simple document. I can just download it, I can sell them to people, and I don't have to really think much about it. Well, the fallacy in that way of thinking is that you're not taking into account the securities laws that are still applicable to the sale of any type of security.
It is still a convertible security.
And because it's actually closer to stock, it's actually more like a security than a convertible promissory note, which is also considered a security. And so you do have to fit state and federal securities exemptions anytime you're selling these safe instruments. So you still should be talking to your attorney about what exemptions are you using in each state in which one of your investors is located, as well as any federal exemptions. And so for those reasons, and this sort of cuts against them being a simpler, more cost-effective document, is some attorneys actually take the position that maybe you still want a purchase agreement to go along with it that might include additional representations and warranties from the investor to fit within certain securities exemptions. It might include risk factors that sort of describe some of the risks of investing in the company. This becomes even more so under the securities laws if the investors are not in fact accredited investors and you're fitting into exemptions that allow for sales to non-accredited investors, and for those reasons more disclosure is appropriate. And so again, you want to have that discussion with your attorney. And I definitely I don't want people to get this false sense that they can go out and just download and start selling them. And I've actually seen that happen. And where that comes back to bite you is that when you do that Series A round, the first thing that happens is they will often ask for a legal opinion from your counsel to the new investors. And one of the opinions that we have to give in those documents is that all prior securities were issued in compliance with securities laws. And if you haven't yet complied with those laws, you make it difficult to raise your second round, and may even cause it to fail for that reason, because during due diligence, your Series A investor will identify these risks and not want to accept them.
Yeah, it's good to keep in mind, and this, by the way, same thing will apply to the Series Seed we talk about next time, is just because you can download the document and fill in the blanks doesn't mean it's the only thing that you have to do to clear securities law. So my general rule is anytime you're taking money from people, it's a really good idea to talk to your attorney about it to keep out of trouble. Let's see, I think we might have another question here.
Got two of them there, Jeff
Yep.
and Alex both.
Yeah, too many variables for a simple answer, but what typical equity percentages do you see with safes?
That's a difficult one, because I actually think this post-money valuation form, it does actually give the investor that certainty that Steve identified in the video about a percentage. But what that actually in effect is doing is valuing the company. So in other words, if you're raising $100,000 from this hypothetical investor and they're going to own 10% of the company, I mean, essentially you've said the value is roughly $1 million. And so, I actually don't like this form if you're a company, partly from the standpoint of then you do have to set that value for the company. I'm sorry, I think can you repeat the question again, just to make sure?
It was just what kinds of valuations are you seeing, well, typical equity percentages, which is a related question.
Yes.
And that's tough to say because, I mean, like a convertible note, at least the original safe, the pre-money safe, you don't know what percentage of the company you're getting. You have a better idea with the post-money safe, but it is actually one of the challenges with both the convertible note and the pre-money safe is you have all of these funds going into this convertible security, and then later on you do, let's say you do $1 million round and you thought that was a 20% dilution. But then you had $1 million of convertible securities that converted, and suddenly it wasn't 20%; it was 40%.
Yeah.
And that's easy to lose track of. So yeah, it is presumably the whole idea with the post-money safe is that looking at the safe as its own round, at least with that what the percent is, and then when you do the priced round that's going to actually cause the safes to convert, then clearly there's going to be more dilution on top of that. So
yeah, so maybe back to the original question, it's hard to value early stage companies. So a lot of times a convertible note round or a safe round is what's trying to bridge you until you can get a valuation. So again, I think there is some tension there because again, if you're choosing a value roughly based upon the amount of the investment, then in fact you are setting that valuation and you have the risk of overvaluing the company or undervaluing the company. And I've seen that happen to entrepreneurs both directions, where they end up undervaluing, and so the investor gets less. That's good for the company, but on the flip side, the investors sometimes can get too much of the company as well.
Let's see. Question from Alex. What can you do to return a value to your investor if you don't end up having a Series A round? And I think it's fair to say you're doing as a convertible security with the intent that you will do a priced round at some point, and that's certainly the representation you're making to investors when you do either a note or a safe. So it certainly is an expectation.
Well, and I think maybe the one great thing about a safe is that I think if you go back to the issue of it doesn't have a threshold for a trigger into conversion. So what you could do is you could actually just set up around post-selling safe notes to one or two investors subsequently, and then just convert all of your safe holders. And so you are doing something for them in that context. So again, I think what you want to do is, you're telling people you're going to do a price round. It doesn't work out. Some companies it never works out. But the company is growing in a more organic way, can't necessarily raise a venture round. And in those circumstances, I think then you go ahead and you convert your safe or note holders based upon either the cap value that's negotiated up front or some other valuation if a cap was not set. And you just try to convert them out. Because again, I think you want to move them to equity in the end.
Yeah, I mean, you technically don't have to with a safe because there's no maturity date. There's no limit on it. But it's a good thing to treat your investors right, because if this one doesn't work out, you'll be out looking again for the next one, and you want to have a good reputation. So I think there are a lot of good reasons to treat your investors well.
And Oregon's a relatively small investor community, so
Indeed.
the word does get out.
Word does indeed. Let's see, if you raise money, does a vesting start from zero? Let's say that I already put $100K in the company, bootstrap. Do I start vesting once I get the investment?
I'm not sure I'm following that question. So vesting is usually an issue around your founder's stock or your early employees' holdings in stock. If you're referring to that, vesting in those circumstances, I generally have that vesting start from the formation of the company. It can even be prior to the start of the company if you in fact were doing preliminary work. And so again, vesting is a flexible concept. It can really be whatever you want to make it, and part of it depends on what you're trying to incentivize, either through employees or through your own personal stock as a founder. I hope that answers the question.
I think it's something that would be defined in a stock purchase agreement. I mean, I always argue that it's actually, this is something that often investors will require. I think it's a good thing for founders to require, because if another founder leaves, you want to be able to recapture at least some of their stock. And the natural time to do it would be right at the beginning of the company when you purchase, because you generally purchase your founder's shares. That should be part of that purchase agreement. So it would, in that case, go into effect right away. Now, it can always say, though, hey, I've already done so much work that what I'm going to do is up front get a 15% vesting.
That's exactly right. In other words, vesting could be, I want to start, only half my shares are subject to vesting. 50% will be vested on day one. I mean, I've seen all different structures, and part of that, again, is having that initial conversation with your attorney about, okay, where are we? Because there is no one size fits all for any company, so you have to talk about what have you accomplished. What is the vesting sort of equating to? Is it for sweat equity that you've put in? So when do you actually start that date? Now, you could also tie a vesting trigger to some raising of capital. So I've seen that. That's an objective criteria that is appropriate for vesting. So let's just say that you had some of your shares subject to vesting, and when you closed your first $100,000 of investment, another chunk would vest. That's something that's typically done for I think for founders who are sort of given the role of raising capital. So it's part of their job. It's sort of almost like a job description. So again, the real focus on vesting is, I think, coming up with objective criteria, and then you can set them as to anything that you can creatively think of.
And I think it's fair to say, too, that, again, I think it's a good idea to have vesting from the very beginning as founders get together. But then let's say several months down the road or a year down the road, you do your first priced equity round, and investors may decide that they want your stock to start vesting again. Because as far as they're concerned, the clock started, when they invested. And they want to make sure the founders are around, for 4 years or whatever. So anytime somebody's doing an investment in you, then everything's open to renegotiation. Yeah. And that's one of the things that they can require, is that the vesting process kind of restarts.
So I think there's two strategies with that. One is you set up your company initially with vesting, and maybe you only vest some of your shares, and you hope that appeases future investors enough. The other is you have no vesting, and then you just wait until they ask you for that. I don't know which particular direction is more appropriate, but it again depends on the company.
The trick is, if you have no vesting up front, then it doesn't protect you.
That's right.
From what happens when, say, a co-founder leaves or is asked to leave.
And that is actually I'd say probably the number one legal risk that I've seen in startups, is when you have a founder leave, has no vesting, gets to keep 40% of the company's stock, and then you want to acquire it back, and it becomes a battle. So that is actually one of the most dangerous situations. I hope that answers your question. It's not really on our safe topic, but close enough.
But related enough.
Ben had an interesting question there.
Let's see. Why should an investor participate in a SAFE if it lacks downside protection, i.e. maturity date or forced conversion, and has vague tax implications? Why would an investor want to do that? Well, I think it is fair to say, having talked to quite a few investors in the Portland area, that's something that they're not totally comfortable with. They like the idea of a convertible note because it has a deadline, right? And that deadline is a cause for negotiation as it approaches, and they like that level of control. On the other hand, down in the Bay Area, safes are very popular, and if you're not willing to go with a safe as an investor, you're going to get left out.
Yeah.
So I think that's part of it, is that, frankly, in the right market, you go with a safe, or you just don't invest.
And I think we've had clients that the ones that have used safe instruments the most have been ones that have raised money in the Bay Area. I mean, partly because the investors will just say, we're comfortable with this, we've done it, here's what we do, and they're willing to buy them straight up.
Yeah. So yeah, but I think, again, it's why you don't see a lot of them up in the Portland area, because people are more comfortable with a convertible note, and it's very standard and very accepted up here. So you see fewer safes as a result.
Yeah, I don't know. Have you heard any anecdotal experience at Seattle? Is it Seattle similar to Portland, or is it more like San Francisco in its safe usage?
I think there has been at least some safe activity up there, but I don't have a whole lot of data. I'm not sure.
Another question there about actually more pertaining to an A round, but take a look at that one.
Let's see, can I jump directly to an A round? For example, if I have a working product and 20 customers, or must I do a seed? I can tell you, A round versus seed round are totally arbitrary labels.
Yeah.
You can call a round purple if you want to, right? I mean, usually, traditionally, if it's a really small early round, you would call it a seed, and then you do a bigger round, you'd call it an A. But I think there is no book that defines what's an A and what's a seed. So really, I think you can call it pretty much anything you want.
Yeah, I think there's two drivers. It's primarily the amount raised and the valuation. So if the valuation, I think, just as an example, if it were under 5 million and you're raising less than 5 million, so you're raising 1 or 2 million, then you're more likely to have people want to call it a seed, and primarily because the traditional Series A was a typical raise of 5 million in the first round. So in order to have a $5 million Series A round, you would need to have, and sell a third of the company, you'd have a 10 million plus a pre-money valuation for that round. So if you're not yet to $10 million and you're not yet to raising $5 million on that $10 million valuation, then it's more likely going to be called a seed, even though they're identical in terms of the types of documents, the liquidation preferences, the anti-dilution protection. So essentially they're the same thing, but it's more of a degree of size.
And if it's a convertible security, like a convertible note or a safe, I mean, most people would expect that would be seed, right? Mm-hmm. That's going to be early. And then later you'd have a bigger priced round, which Correct. Might well be called, at that point, a Series A. So, I mean, that's typically what would happen. But yes, you get all kinds of variations.
But again, there is no right one-size-fits-all for every company. So...
let's see, and Kevin commented that Seattle, not as many founders, lots of new and active angels. So a standard safe note with properly, it really depends. Yeah, no, I don't have a lot of experience up in Seattle either. So, but yeah, my impression is it's not super common up there. I think they still do a lot of notes.
I think generally my view of the Seattle investment market and the Portland investment market is they're similar. There are more venture funds, but generally similar approach to companies that in both markets, as opposed to the Bay Area is slightly different.
And the other thing I don't have any information on is, even in the Bay Area, how popular the post-money note is now that it's out there. I mean, it's arguably a little bit more attractive maybe to an investor because you have a little better idea, at least, of what you're getting for your investment. But has it? Curious if any of you out there have any perspective on whether the post money safe is being used very much. I haven't seen one, but then again, we don't see very many safes in general up here in the Portland market.
The question there again, what are the advantages of doing a round in Oregon?
Okay, so what the advantages of an Oregon entrepreneur doing a round here in Oregon? Doing an early stage round, is a whole lot of it is based on relationship, and one advantage up here is, hey, you know people who know people. You can get introduced. You can develop the relationship, and seed funding is very much based on relationships. So that's an advantage. And even though people up here tend to like convertible notes, there's nothing particularly wrong with a convertible note as a way of doing funding. It has the same key advantage of a safe, which is it puts off your valuation until later, and it's simple. With very very few things to negotiate. So it's a relatively easy thing to get into place. But I think that's maybe the biggest reason to look at local funding, as opposed to just looking at Seattle or the Bay Area, is there are plenty of investors up here, and you can definitely close a seed round up here, and it's easier to get introduced, and frankly easier to make the rounds. You'll typically meet with an investor multiple times before they're going to write you a check, and doing that in Portland is just easier than doing it down in the Bay Area if you happen to live up here.
That's not to say many companies that are located in this area don't go to those other markets and make the rounds. It is just more difficult. I mean, one of those, those venture funds, for example, that are looking at investing in Portland, they have to make a decision. Do we have a venture partner who's willing to join your board to travel to Portland? And so I think you're at a disadvantage relative to other companies that are in their market. And so you have to prove that you've made more traction, you've gotten farther, you've got more customers. And so I think you're at a slight disadvantage when you go outside of the market. And that's not to say that they wouldn't make investment, because it happens all the time. But I'd say the numbers game is such that there are fewer per number of companies looking.
Harder to do. Now, having said that, when you're looking at a larger round, if you're looking at multiple millions of dollars, you are almost certainly going to be looking outside the area, because we don't. I think it's still true to say that we don't have a single well, let's see, very, very, very few, at least, traditional venture capital firms up here that that would look at multi-million-dollar rounds. We just don't have that many headquartered here in Portland. We have one or two that have people based here, but not headquartered here. So when you look at a larger round, yeah, you're pretty much forced to go out of the area. Seattle, the Bay Area, East Coast, certainly not just out of Portland. Let's see, what else do we have here? From Jim, what do you think of putting terms into the safe or note to waive the rights to liquidation preference beyond cash in when the safe converts way above the valuation cap? So waiving the rights to liquidation preference beyond cash when the safe converts way above the valuation cap.
So the way I take that, Jim, is that I actually think you're referring to almost what Steve talked about on the videos, that the security that the safe converts into is not the same security as the Series A investors, partly because of that liquidation preference issue. So in other words, the way I'm reading your question is that if, for example, the note holder pays 50 cents a share because of the valuation cap, but the Series A investor is paying $1, you actually split the securities into two types. One in the Series A preferred, and the other is a safe preferred, and the safe preferred gets a different liquidation preference. It gets one that is related to its original issue price, which was lower, so that that safe holder doesn't actually get the sort of double dip that I think that Steve describes in the video. And I actually think that that's a nice feature that's built into the safe instrument just on its own.
That's not always included in a convertible note, which can have the same issue if it has a cap.
That's right.
I guess the interesting question is I think that is built into the boilerplate of both the pre-money and the post-money safe. Both versions.
So I don't at least think that we need to amend the safe instrument to take care of that. Now maybe there could be some clarity around that.
I guess from the investor's point of view, there's a question of, well, is that reasonable? Is that double dipping not okay? I mean, should it be there?
Yeah. I mean, if you're a note holder, you might argue you want that extra payment because it represents your early risk being paid back sooner and to a greater extent.
I mean, there's at least an argument there that says you put the cap in there for a reason, and that's to protect against that big upside and or that big valuation, and double dipping on the liquidation preference is just another way to protect you. So I suppose you can argue it either way, depending on which
whether you're an investor or a company looking to,
or whether you're one of the safe investors or the later equity investors, right?
Yes.
Who gets a worse liquidation preference. But so yeah, I don't know. I mean, it is interesting that at least it is standard, so you know it's there. But you could still argue as to whether or not it's an appropriate thing to be there.
And hopefully we understood your question correctly, Jim, and answered it. If not, let us know, and we'll try to further discuss.
Let's see. So, hey, any other questions there? Please don't hesitate to type them up. Because it's always more fun when we have your questions as opposed to making them up ourselves. Rather address issues that you have.
Yeah, and I think Steve touched upon this in the video, but I'll talk about it just real quickly to maybe fill a little bit of time. And that is, these safe investors actually get the same instrument as the Series A investors or seed series, whatever preferred stock it's converting into. So generally those rights are not just that liquidation preference we were just talking about. It also includes particular voting rights, the rights to make certain decisions as a voting class, anti-dilution protection, which means if the company issues new stock at a lower value, the earlier shareholder gets some additional shares to protect them from that lower down or down round, lower price. Now that actually becomes important in that circumstance that we were just talking about with the SAFE preferred stock and the Series A preferred stock. If they each have a different original issue price, which is how it's handled in the articles, then what you've done is you've actually made it so that you could issue stock less than the Series A price and triggered anti-dilution for those shareholders, but not for the SAFE preferred shareholders, because you haven't gone down as low as their cap valuation. So again, it's an interesting circumstance. I've never seen it occur, but it could, and that would be protected, or the parties would be put in the appropriate places by having those two different or distinct kinds of stock.
And by the way, some of those terms that you run into in a priced round, like liquidation preference, like redemption rights, like registration rights, like anti-dilution protection, we talk about a lot of those in the next video coming up.
Yes.
In the Series Seed. Those are not actually all in the Series Seed, but they get talked about as specifically in some cases to say, by the way, this is commonly seen but is not in the Series Seed. So if you're curious about some of these bizarre terms, and some of them are fairly bizarre and complicated, you'll learn more about those in the next video, which actually should get posted this afternoon. Let's see, another question. What is the best way to oh wait, let me back up. Kevin's question: how to choose a law firm for a startup? They all offer info, but how do we find the firm that will act as a lead, shopping us around to investors? Well, I'm sure you're not biased, Ernie. But
no, I'm not biased at all. But no, but I would say the best way to look for an attorney in this space, and again, I try to be fair to all my competitors, is this is a specialty that's just as much as a specialty as someone who does, family law. I mean, I don't practice that kind of law. I work with companies and work with startups, and so that's what I do. So I think you're clearly looking for someone who does this regularly. I would say there's probably a handful of lawyers in town that, again, without naming all the firms that do this, and I run across more than anyone else. I would certainly say they're probably the best place to start, because they have that unique experience of having been through these transactions for the last 20 years. That's what you're really looking for. And by having gone through these transactions, they know, not only investors on how the investors act, but they sometimes know those investors that they can make introductions to.
And I think, so yeah, you work with a firm that has an emerging business practice, and they will work with other investors, and they can and will, give you introductions. So it's certainly the advantage of working with a firm that really focuses a fair amount of resource on doing startup kinds of deals. Let's see. Tomer asks, what is the best way to reach investors, i.e., where do you find them, or do you cold call? I think angel investors, at least early on, you can roughly speaking come in two categories, right? Those that are in an angel group and those that aren't. Those in an angel group are relatively easy to find. Around town, it's Portland Seed Fund, it's the Oregon Venture Fund, and so forth. So the groups are fairly easy to find. But even with the groups, actually, it's not a bad idea to get an introduction, because getting a referral, it's kind of like looking for a job, right? You can send out a bunch of resumes, or you can get an introduction. And usually getting an introduction is a better strategy. The other way, though, is in terms of just individual angels, which frankly is probably the bigger resource of money out there, because there are a lot of accredited investors in the Portland area, that's a matter of I think the best way to approach them is networking, is getting introduced,
and to take advantage of the various pitch events. There's one tonight that the Portland Seed Fund's sponsoring, so there are many events where you can pitch.
Yep.
And then the investors will sometimes attend those events in order to see the pitches, because they're looking for deal flow. And so you're looking to find places where that deal flow is available, and then the investors will be there. And it's like anything, you're trying to find you're trying to connect with someone who understands your business, either has a background in it or has some interest in what you're doing. And so that sometimes takes, lots of touches with various people to get to that place.
But the pitch events, again, are just another effective networking route. Even if it's a competition and you don't win, but you get exposed to a lot of people and meet a lot of people, you can walk away with some relationships that turn into investment. You never know. So I guess the good news about the Portland market is that there are many events and many opportunities to get out and network. And as Jim said, one of those coming up, that is this evening, isn't it? Is the Portland Seed Fund event. So yeah, there are plenty of opportunities to get out and meet people. And that's always a good way to do it. Let's see. Don says, in your opinion, which of the instruments, C-Note versus SAFE, keep early investors in better alignment with the later investors outside of the price paid per share, post conversion, etc.? Better aligned.
I guess I'm thinking about that, and I don't really see a material difference. So in other words, once you've converted, one has a SAFE series preferred stock, and one has either the seed or Series A series stock. So essentially, they're going to be aligned. I think the one issue is that price paid issue can create the biggest tension. Sometimes can cause a Series A shareholder not to want to participate in a transaction if there's too low a cap, and the note holders are going to get a larger percentage. We touched on that, I think, in the last answer Q&A session. But I think once you've actually made the conversion, essentially they are in the same position.
They're shareholders.
Yeah, they're shareholders owning the same classes of stock. They have the same voting rights, same liquidation rights. So again, I don't think I really see a material difference in which one would be better in that regard.
Let's see. And Jim did note that, yes, it's pitch for beer, which is, it doesn't get more entrepreneurial than that, pitching for beer. 4 to 6 p.m. at the Portland State Business Accelerator today. So check that out. Tomer says, what's better, raising 10K from 10 investors or raising 100K from one investor?
100K from one. It always comes down to, once you have to start taking in investors, and the larger your cap table gets, the more people you have to manage, and there's just a cost in that. And that's one thing that a lot of companies and entrepreneurs don't start thinking about, that just managing a shareholder and note holder list becomes complicated, because they're entitled to notices, or they're entitled to various pieces of information, and the longer that list gets, the more money and time you spend in managing it. So if you had one person who's willing to write a $100,000 check and who will then learn your business, and you can have a relationship with him, that's a much simpler situation. Now, that's not to say you don't take the 10 when that's what you've got available. You take the 10.
If that's what you got, that's what you've got. And I totally agree that investors require management and paying attention. And so the more of them that you have, the more of that you have to do. There's some advantage in having a larger network of investors, because then you have more people that have a vested interest in your success, and they have a network that can help. And so that's kind of a plus. But it is more of a management challenge and more time.
Yeah.
Although it's probably also true that getting one person to raise $100,000 can take a little bit longer.
Yes.
On the other hand, running around between 10 people, well, of course, you're going to run around between a lot more people than that to get the 10. That can take a lot of time too. So it's a trade-off. But yeah, if you can get one large investor, it certainly saves you a lot of running around.
I think the most typical path from companies that I see is the first investor is somebody it's your aunt, $25,000. You get another 15 from somebody that and then what you've got to convince is somebody else who's outside of your personal circle to be the next one. You get that, and then once you sort of are moving into the third-party network, now you're hitting networks and maybe it's a Thai angel or it's a one of the Oregon venture fund investors who individually puts in money. And the great thing, as Steve mentioned, is once you've got those people joining your company, they actually are then championing your company and your business plan to other people they know in the broader groups. So again, I think building to that is really what you're looking to do.
And I think Kevin sort of made a similar comment to mine that 100K is preferable, but hey, sometimes investors bring relationships, and more can be better too. Let's see, and Ben pointed out a good thing to plug for Beaverton here. Thai Oregon is hosting the pitch event in Pitch Club in Beaverton, which happens, I think, regularly once a quarter, perhaps. So that's coming up soon also.
And the last question there on the bottom, that's a good question.
Yeah, so what's the typical process for transfer of money to a company upon purchase of a safe or even a C note? A check given for a signature on safe legal document provided by the company ?
So it can be as simple as that. So in other words, the company could print it out, you can have them sign it, write a check, and give it to the company. I think my preferred process, and again, it's a little more formal, is that oftentimes we'll have the documents that the company's using for its sales of notes or safes prepared. What we'll do is, you tell us who the investor is as your attorneys, we'll send it to them in a DocuSign, they'll sign it, we know it's been signed, they can deliver the money to you, but the benefit on the back end is we also know where they're located, if there's a securities filing that has to be found for that person, if there's a new set of blue sky laws because they're in a new state, we can then take care of that, and it's not forgotten, so that you get down the road and you've got 6 or 7 of these and all of a sudden you've got no backup done. So it's sort of working with your attorney. So again, it can be done both ways, and I'm not saying one is preferred, it's just that it allows you to manage, again, your cap table better if someone's sort of helping you with that process.
That might be a good thing to comment on too, Ernie, that you just broached the topic of different states.
Yes.
What do you have to worry about as an entrepreneur if you get investment from different states?
Yeah, so everyone knows that the SEC issued, we have federal securities laws. These came about in the 1930s. Well, about the same time, every state also adopted securities laws. So if you sell to an Oregon resident a note or a convertible note, you've got to meet federal securities laws, but you also have to meet what they call state blue sky laws, which are an equivalent to the federal law. And sometimes by using a federal exemption, there's an equivalent one in the state that you just can use the same basic exemption. We'll file what we call a Form D with the SEC back in Washington, D.C., but you can also often file that same Form D in the state. Now, some states, California being an example, they have much different regulatory scheme. They have their own form. They have pretty high fees. It's also more difficult to find an exemption, so you need to then plan on that. So again, having conversations with your attorneys at least prior to selling a note is the best way to deal with it, because you can say, this potential investor, we're getting close to getting them signed. They live in California. What exemption do we have? What filings? We'll make sure we get those. So that's back to that process. It's nice to know when that money comes in. That's what triggers the filing requirement. Some states have a limitation on that filing. It has to be filed within a certain period of time after the sale of securities. Sometimes it has to be done before you sell. There are some states that get pretty sticky about that. I ran across one in, I think it was Maryland a few years ago, and we had a sale. The client did some sales, didn't tell us about it. A filing wasn't made. They had a penalty. Then basically the state securities regulator said you can never sell again in Maryland unless you either pay this big fee, and then if you ever have another failure like that, you never get to sell again. So I mean, there are restrictions that can occur because of that. So just again, having that conversation is helpful.
So again, it's more complicated than just getting the note signed or getting the safe signed. There's federal documentation to be filed, and that keeps you legal. And again, as Ernie said earlier, prevents a lot of issues later on when you do a priced equity round. let's see. We should do sort of a final call for questions here. We obviously started late because of the technical issues, but we're kind of coming up on 1:15 here. So if you have any final questions, you might go ahead and type that in so we can get those addressed before we shut things down here. But I think we've certainly covered a number of good topics. Ernie, thinking about the things that came up, any other final thoughts you have on safes or safes versus C-notes?
One thing about safes, and I think, again, they are simple to obtain as well. So if you Google a Y Combinator safe, you can find the Y Combinator site. The 4 different versions are all listed there. You can download them. I would recommend anyone who has an interest in this to go ahead and download them and take a read through and highlight some of the provisions. And then if you did have further questions, there's always ways you can reach out to us and we can answer questions, or contact your own attorney about them. And as Steve mentioned on the video, the various forms are like, what was it? No cap, no valuation. Let's see, I'm trying to remember the 4
cap
different...
and valuation,
yes.
And then no cap, no valuation, but most favored nation.
Yes.
Yep, those are the 4.
And we didn't touch on most favored nation today, although we touched on it in the prior Q&A question under the notes, under convertible promissory notes. But just again, a brief description of that is essentially giving the best terms that you've given to someone else to a prior note holder. And that is an issue that we also addressed last time, is what happens when you do offer better terms to someone later. Do you have to go back to all of your prior note holders and offer the same? If they don't have that most favored nation provision, then you generally do not. Now, sometimes the securities perspective of the world is if it's all one offering, there is some question that if you didn't offer some terms to a prior investor, maybe you should be telling them, because again, they can take the position that they have not been, it wasn't disclosed to them that better terms were available. And so again, I would be careful about changing terms midstream. At least, again, think about it before you do it. Maybe you close a round and open a new round, and it's clear that it's a different round of securities offering.
All right. Well, I think we're running out of questions.
All right. Well, thank you, everyone.
Yep. Thank you, everybody, for joining us again. Sorry for the technical snafus. We'll be sure to do better on the next one. We'll have coming up in September a Q&A session for the Series Seed. And again, I believe it should be late this afternoon that that video will actually post and give you an overview of what a term sheet for a fairly simple priced equity investment looks like. With that, thank you very much, Ernie, and thanks to Jim for keeping track of our questions here. And we'll see you all next time. Thanks for watching.